We've talked a lot about capital budgeting and how it is that we're going to evaluate all of the different projects that we have available to us. We talked about the payback method and net present value, internal rate of return, and evaluating risk and inflation, all kinds of different things. And now we're kind of getting to the end of this and turning our attention now to making a decision. We've been using these screening methods to collect a list of all of the different investments that would be beneficial to the organization, and excluding all of those potential investments that would not be beneficial to the organization. But what we probably have is this nice long list of beneficial opportunities that we could invest in. In a perfect world, we would have enough money to be able to invest in all of them. Unfortunately, I don't think any of us live in that perfect world, and so we have limited resources that are available to us to invest. We cannot make all of the investments that would be beneficial to the organization. And so what we need to do is have a way that we can determine which investment should be made first, which investment should be made second, third, and so on. And so that's what we're looking at here with this topic of capital rationing and capital budgeting. We don't have enough capital to make all of these investments. So we need to determine how we're going to allocate that capital, how we're going to use that limited capital that we can, with the goal of providing the highest total return for the company. That's what we're trying to do. We're trying to maximize the return to the company, the benefit to the company, out of the money that we have available for these different investments. And what we've been doing so far is simply determining whether or not an investment would be beneficial to the organization. Now we need to list them. And again, this isn't going to be just one specific tool that we use and then we're done. This is a process that we're going to go through. But we start with what is called the profitability index. This is going to get a benefit cost ratio that represents the ratio of the benefits to the cost. The benefits are the present value of those net cash inflows. The costs are the present value of those net cash outflows. So we're going to get that ratio between the net present value of the inflows and the net present value of the outflows in order to determine which investment we should make first, second, third, and so on. And again, this is a starting point. So we'll go ahead and look at the calculation. It's not that difficult. We take the present value of the future net positive cash inflows and divide that by the net initial investment plus the present value of any future net negative cash flows, which there may not be any. There may be no years in the future in which there's a negative cash flow, a net negative, total negative cash flow. But if there are, that's treated as part of the denominator. So what we're going to do, and we'll see this in an example, is we calculate the profitability index for every beneficial project that we have. All of those yeses when we were doing net present value and internal rate of return. But we can't simply start at the highest profitability index and work our way down, because we have to remember that we have a limited amount of money and some of these projects have different amounts of investment. So what we need to do is put together what is the combination of investments that still fit within our budget that will maximize the return. And what we're looking at for maximizing that return is the highest total net present value. What are the investments, the combination of investments that we have enough money to make that will provide the highest net present value for the organization? And we'll go ahead and we'll look at this with an example. So, CHIPS Inc. has the following investment opportunities. We have requirement investment outlays and the present value of the future estimated net cash inflows for each of the investments are as follows. So we have 4 projects. The present value of the investment, $300,000, $450,000, $650,000, and $750,000. And then we have the present value of those future estimated net cash inflows, starting at $350,000, going all the way up to $1.2 million for project 4. Okay, so those are the investments that we could make. CHIP Inc.'s budget ceiling for initial outlays during the present period is $1,500,000. The proposed projects are independent of each other, and so the question is which project or projects should CHIPS accept. We have $1.5 million available to us. Now, if we just look at what those investments are, we could invest in any one individually. We could invest in projects 1, 2, and 3. We could invest in all 3 of those. We have enough money to do that. But if we invest in projects 1, 2, and 3, we can't invest in project 4. We could invest in 2 and 3. Okay, well, if we invest in 2 and 3, we'd also want to invest in 1, I guess. But we can put together whatever combination, so long as it doesn't go over $1.5 million. So what we're going to do in this is find that combination of the projects that are going to not be more than $1.5 million. Okay? All of them is $2.15 million. So we can't do all of them. The first step is to calculate the profitability index and the net present value of each project. Profitability index is the present value of the future estimated net cash inflows divided by those negative cash flows. And the net present value, we know what that is, taking that net initial investment as well. And so taking that information, here's what we get. For each project, we have the present value of the future estimated cash inflows, the present value of the investment cost, that gives us a net present value, and at the far right, the profitability index. So project 3 has the highest profitability index and the highest net present value. The next highest profitability index is project 4, and it's also the next highest net present value. And so the highest profitability indices, 3 and 4. They also have the highest net present values, and so that's where we're going to invest. Those are the first 2 investments we're going to make, and those 2 investments are $1.4 million. So we can make those 2, but we can't make any other investments. Now, we could make investment 2 instead of investment 3 if we wanted to, but we have much less net present value if we were to choose to invest in project 2 instead of project 3. And so it's a combination. In this one, it worked out well for us because the profitability index and the net present value gave us the same kind of conclusion in terms of how it is or what it is that we should invest in. So in the situation where we don't have enough money to make investments in all of the beneficial opportunities that we have, we're going to use the profitability index as one of the tools to kind of point us in the right direction to how we can maximize our overall net present value. Again, the formula, the present value of the future net positive cash inflows divided by the net initial investment and any negative future net cash flows that there are. So it's a tool. It's a starting point. But again, our overall goal is to maximize net present value. And the profitability index is what's going to help us see where it is we should be looking first to make those investments that are going to maximize the net present value for the organization.